NC Personal Lines Practice Exam. Welcome to the quiz. What is the primary risk covered by credit insurance? Is it A, insurance against poor credit scores? Or B, insurance that pays off a specific loan if the borrower dies or becomes disabled? C, insurance for credit card fraud? Or D, identity theft insurance? The answer is B. Credit insurance, often called credit life or credit disability, is tied to a specific loan or credit account, like a mortgage, auto loan, or credit card. It pays off or reduces the outstanding balance if the borrower dies, credit life, or becomes disabled and can't work, credit disability, protecting the lender from default due to death or disability and relieving the borrower's estate or family. Poor credit scores are not insurable. Fraud and identity theft have separate products. The primary coverage is loan payoff protection upon death or disability of the borrower. Next question. In life insurance, what is the free look provision? Is it A, a period, e.g., 10 to 30 days, after policy delivery during which the policy owner can cancel for a full refund? Or B, a look at the policy before buying? C, a free insurance inspection? Or D, a period where no premium is due? The answer is A. After receiving the delivered life insurance policy, the policy owner gets a free look period, typically 10 to 30 days depending on state law, to review the contract. During this time, they can return the policy for any reason and receive a full refund of all premiums paid, with no questions asked and no cancellation charge. This protects against pressure sales or misunderstandings. It's after delivery, not before buying. It's not an inspection or premium waiver. The free look gives a no-risk review period post-purchase. Next question. What is the purpose of a facultative certificate in insurance? Is it A, it is a certificate issued by a surplus lines insurer for a specific risk? Or B, a certificate of insurance for a financed vehicle? C, a certificate of completion for an insurance course? Or D, a certificate for facultative reinsurance? The answer is D. Reinsurance is insurance for insurers. Facultative reinsurance covers a single specific risk, not a class, on a case-by-case basis, where the reinsurer evaluates and accepts or rejects each submission. A facultative certificate evidences that reinsurance placement for that particular risk. Surplus lines certificates are for non-admitted primary coverage. Financed vehicle certificates show insurance for lenders. Course certificates are education-related. The purpose is documenting facultative reinsurance agreement for an individual risk. Next question. What is moral turpitude in the context of policy exclusions? Is it A, an act of baseness, vileness, or depravity that can void coverage for related losses? Or B, a minor traffic violation? C, a requirement for moral behavior by the insured? Or D, a type of hazard? The answer is A. Some insurance policies exclude losses arising from or connected to acts of moral turpitude, meaning intentional, dishonest, fraudulent, or depraved criminal acts showing a serious lack of morals, like fraud, theft, assault with intent, or felony crimes involving dishonesty. If a loss results from such an act, coverage may be denied or the policy voided because ensuring deliberate criminality violates public policy. Minor violations like traffic tickets do not qualify. It's not a general moral requirement. Hazard is risk type. Moral turpitude exclusions target serious intentional wrongdoing to prevent covering illegal profits or acts. Next question. What does loss ratio measure for an insurer? Is it A, the ratio of incurred losses plus loss adjustment expenses to earned premiums? Or B, the ratio of premiums to commissions? C, the ratio of claims paid to claims denied? Or D, the ratio of new policies to lapsed policies? The answer is A. Loss ratio is a key profitability metric for insurers, calculated as incurred losses plus loss adjustment expenses, divided by earned premiums, usually expressed as a percentage. It shows what portion of premium dollars goes to paying claims and adjusting them. A high loss ratio, e.g., over 70 to 80%, indicates heavy claims relative to premiums, potentially unprofitable underwriting. Commissions are expense ratio part. Paid versus denied is internal efficiency. New versus lapsed is retention. Loss ratio directly measures claims cost against premium earned. Next question. What is a bailment exposure? Is it A, when someone leaves personal property in the care of another, e.g., a dry cleaner, or B, the act of bailing out a boat? C, a type of bond? Or D, an exclusion for property in storage? The answer is A. A bailment occurs when one party, bailer, temporarily entrusts personal property to another, bailee, for a specific purpose, like repair, cleaning, storage, parking, or shipping, with the expectation of return. The bailee has a duty to care for the property and can be liable for damage or loss due to negligence. This creates a bailment exposure risk of liability claims if the bailee fails to protect the item. Bailing water from a boat is unrelated. Bonds are surety. Storage exclusions are policy terms. Bailment exposure arises from custody of another's property. That's it for today. Don't forget to like and subscribe. Tell us how many you scored out of 6 in the comments, and let me know what topic I should post next. Bye.